All right, ladies and gentlemen, it's March 9th, 2023, and the bank run is happening. So I have all of this cash in a Swiss passport for no good reason. I just wanted a thumbnail. But what happened today, SIVB Bank, SVB Bank, the ticker is SIVB. They had a record collapse. They've dropped more on record than 1987. They've been around for a long time. SIVC, what they actually do is they bank with a lot of venture capitalist clients. And today we woke up and they announced a bunch of different changes. They were selling assets. They did a stock offering. They lowered their net guidance and a lot of other things. But it led to a panic. Even the bank stocks had their worst day since June 2020. And that's nothing small, man. That's really big. But now the fears and risk off sentiment, it may very well be telling us the next issue we will start dealing with in 2023. So let me show you this. You see the Fed futures? We've been talking about this. If you've been watching the market the last couple of weeks here, everybody has been saying, oh my gosh, the Fed's going to raise interest rates. They're going to do 50 basis points now. And everybody was freaking out, right? Well, middle of the day, this dropped 20% and the odds of raising rates dropped because of this event. This brings back all the recession fears. This is getting to the point, if this situation gets further from here, it's actually not going to allow the Fed to raise rates. That's the type of situation we're talking about here. So I will tell you that, but the other thing I really got to start with, today is just day one. It's the first time we're seeing this. We've seen this a lot in the market. I wouldn't be surprised if a couple of days later from here, analysts are like, oh, we think it's an overreaction. Oh, we actually think it's going to be a headwind, a tailwind. They're going to say all this stuff. And then the problem is here today and then it's gone tomorrow. A good example of what this reminds me of today is the whole Liz Truss situation in the United Kingdom, where everybody freaked out. The bonds were on the verge of collapsing in the United Kingdom. And then within 7 days, you heard nothing about it and everything got resolved, right? So what I'm trying to tell you here is that this is the early stage. I think we're early with this, and I don't necessarily think that this has to turn into anything negative. But for now, it is very bad. So I have a stapler here too to look studious. But what I want to start with is what happened today. So pretty much SIVB had a borderline forced asset sale. It's not like they got margin called. Nobody asked them to give their money back, but they thought it would be in their best interest. And they even cited Jerome Powell and what he said about higher rates for longer. And they pretty much said, hey, we want to sell all of these bonds and we're going to buy them back at higher rates, but we think it's in our best interest to sell these assets. Now, what they did is they sold $21 billion in assets. Then they did an offering for $1.5 billion of shares. So not only did they sell these assets, which they sold for about a $1.8 billion loss, they then sold more stock to fund that loss, and then they lowered their net income for the rest of the year. The interesting part about all of it is that a lot of analysts were saying, well, we lower our price target by $50, and people were saying it looks like it's giving them wiggle room. And even the CEO, he said, don't panic. He said, we don't have a problem unless everybody thinks we have a problem, and then customers start pulling their money out. And we're going to talk about that. But the whole point was it started with SIVB Bank today. But then, the fact that it was kind of a forced asset sale, I say that with quotations, it kind of woke everybody up, and that risk sentiment spread to all the banks because now this is everybody's worry. So let's talk a little bit as to why or how they got into this mess. It's not simple, but it is. But SIVB is still very unique. The first thing is SIVB, a lot of their clients are venture capital. So they fund a lot of Silicon Valley, tech, emerging growth companies. Them and Cathie Wood kind of go hand in hand. But they have a lot of VC clients. These are companies, people paying a lot for valuations, overpaying for companies, maybe giving it to Sam Bankman. I don't know. But liquidity is usually pretty tight in that realm, or they spend a lot of money and there's periods without steady cash flow coming in. So that's the first part about it, is that they had all of these clients and they did good in the beginning. 2019 to 2021, they ballooned their assets. I think they almost doubled all of the assets under the bank, like 90 billion or 60 billion, all the way to 180 by the end of 2021. 2021, but now it was like end of 2021 where they got into the problem because they took $90 billion of that money and they decided to buy long-term 10-year plus bonds that they want to hold till maturity. They said, we plan to hold this for 10 years. But they bought them at like 1.6%. Go look at a 10-year now today, it's almost at 4%. So the fact that they bought those at 1.6%, now they're at 4, even though the yield is up, they're locked in a lot lower. That means that they have lost money on all of their bonds. And essentially, they have been holding these unrealized losses for quite some time. This hasn't been a secret. And that's the interesting part about this, because there's a lot of other companies in Wall Street that own bonds. A lot of them may be down. Maybe they hedged it a lot better. And they even talked about hedging today. But the point is, this is kind of common, right? And I say that with a grain of salt. But in this case, they have all this money in bonds. The value is hurting their balance sheet. They have unrealized losses. And what they're saying, or what analysts have been saying, is that now a lot of customers have been pulling their deposits. Their deposit ratio has been going down. And why this could affect other banks, we were just talking about cash and short-term treasuries yesterday. Guess what? If you could get 4% from the treasury, you're not going to deposit your money into a bank. So this is why the rest of the banking stocks are a little bit worried there, but it's pretty simple in this case. They have these losses, their client deposits start winding down, whatever problems are having in VC world, crypto world, whatever, but now they start losing these deposits and they're saying, okay, well, we need some money now. We're not making as much. We have a problem. They said, let's sell these bonds, free up the balance sheet. We're going to rebuy them out here. But it's kind of a balance sheet situation. But like the CEO even said, if clients keep asking for their money and they have to give out all their money, and now all of the rest of the money they have is tied up in these liquid bonds that they're at a loss at, only way to get money back would be to sell or sell shares. So in simple form, bonds get a bunch of unrealized losses. Customer deposits go down. Now they need cash. Your only option is make more money or sell your other assets to pay for whatever else you need to do. So now, why is this a problem? Why is this a problem for Wall Street and anything in between? Because now this is the first time since Powell started raising rates where we're actually hearing about bonds creating a problem. Just like the UK, when the 30-year gilt went above 4%, there was pension funds and all of these people that were positioned, and they were saying literally anything above that rate we cannot handle. So in this case now, the problem is a lot of banks own bonds, and now the question is, okay, if rates keep going higher and they stay higher, is there going to be a breaking point? And now, if everybody on Wall Street who own all the banks, if they own bonds, if they're susceptible to the same thing, if there's any outside shock that pretty much slows anything down or slows any other incoming revenue, well, they may be forced to be in the same position as SIVB, and then they may be forced to sell other assets or sell assets that they have at a considerable loss just to make up capital. So this is the problem, but now tying it into the Fed, like I'm saying, this very well may be the next financial issue we have in 2023. And it's kind of bittersweet because this whole time we've been like, okay, inflation, jobs, non-farm payrolls, inflation, it's kind of been the same thing, right? And you've seen how people respond to it and not really. Well, this time around, this is actually new. And now this is something where the risks get really high. And now you're going to get everything from forced sales, or maybe we're going to find out there's a lot of losers, and that could exacerbate any sort of liquidity crisis. Essentially, with the rates up so high, if that lowers customer deposits, we may run into this issue on a bigger scale. And now we are finally starting to see that there could be a bond risk. And if maybe yields do go too high, this will finally be the cracking event, or something that either causes the Fed to change course or will actually bring down the economy in a lot of things in many ways. And now that's the final point that I started with. I'm telling you, this is how crazy today was, because the market dropped, the bonds went up. The market dropped, the dollar went down. That's not what you've been seeing at all, but mainly what happened with the rate hike odds. It got to the point where the banks started selling off so much and people were getting worried about this, where rate cut odds began to rise up. That's not what's been happening here. Remember, beginning of the year, people are like rate cut, and then they got away from it, then the bonds sold off. Well, now if this situation gets bad, if it spreads, if this really becomes an issue, it's no longer like, oh, well, they're going to raise rates. It's like, wait, they can't raise rates if this creates a bigger systemic problem that leads one into the next. So that's why I'm saying it's bittersweet, because it's like it's a new information, but it's kind of scary. And then, like I said at the beginning, this is all just the beginning. So we don't know. It might change in a couple of days, but a lot of people asked about this. This is why the market went down today. And this is the only answer I could give to you, because the jobs report was good. So now these next couple of days, jobs report tomorrow, CPI, then Powell, that's going to determine everything. But this issue with banks, this issue with people holding bonds, the effects of unrealized losses, and anything in between, even customer deposits, this very well may be something we will watch come to life in 2023. So I hope you're ready, Chad. But that's it. That's my update. I don't know. Do you like the in-person? You know, we still got the bull, baby. Oh, do I look as, you can't even see it, man. You should see my hairline. I'll show you my hair. Hold on. I don't know, man. But I love you, Chad. I'll see you in the morning, bright and early for that jobs report. And let's go, baby. It's so awkward without, I hit the horn, staple. Okay.